Let us dig in with our expert panel. Michael Pinto, Delta Global Advisors. Kudlow & Company contributor Jerry Bowyer of Benchmark Financial. Don Luskin, Trend Macro. And CNBC contributor Jared Bernstein, Economic Policy Institute and author of Crunch. What got crunched this week, Jared, was the recession scenario. It got crunched. What's your take, buddy? Let me start with you right there at the top, since you're Mr. Crunch.
Well, first of all, crunch is referring to what a lot of folks in the middle of the income scale are experiencing right now, which is truly falling wages. And in fact, by the way, speaking of that, if you looked at today's personal income report for April, you found a decline in nominal wages. Boy, that's really not good news for second quarter. Now, the rebates aren't in those numbers yet, hardly at all. So probably things will pick up a little bit. But I think if you're looking at Q2 right now, based on at least today's personal income report, you don't have to go recessionary. What you have to recognize is that this economy is solidly below trend. That's what matters. We're not supporting the job or income growth we need. And the victim right now is not, I don't think, financial markets. It's not the exports. It's the American consumer, who's still 70% of this economy. So, you know, no sunlight quite yet, but maybe not recession.
It's very good to hear that you're as cheerful as always. Jerry Bowyer, let me just follow up. I'm looking at today's personal income and spending report.
Right.
Wage and salary income over the past 12 months, which really is what matters, up 4.5%.
Right.
Now, even with gasoline prices and food, the headline inflation number was 3.2%. So if I go 4.4 wages minus 3.2 prices, I still have positive real incomes, Jerry. What do you make of Jared? Jared's trying to crunch the numbers to support his book.
I'm reporting what the monthly data show.
Jared, I'm just giving you the trends. 12-month changes is how we should interpret. Wait, go ahead, Jerry.
No, I don't think so.
Look,
Jerry, your turn up at bat.
Well, for an economist, personal income's a real important number. For a regular person, a consumer, it's disposable personal income that matters.
Right.
It's the take-home pay. That's what counts. So, Jared, when you're looking at the monthly numbers and you say, yeah, wages are, are flat, if you look at disposable personal income over the past year, that's relatively strong.
Yeah.
What counts is take-home pay.
Yeah, and that was actually negative in April. Real disposable income down, I think, 0.1%. So,
but year over year,
I totally agree with you. But I think right now we have to look at more up-to-date turning point kinds of data.
Well, Don Luskin, what really counts is this rip-roaring stock market of ours, which extended big time into NASDAQ this week. Computers and telcos and SOX and Cisco and the whole 9 yards. Talk to me about this big stock market run.
Well, March 17th, Bear Stearns Monday was definitely the bottom for stocks, no question about it. That's when the market started to discount the restoration of confidence. It was going to pull the economy out of the fear-induced slowdown that began last November or December. We're not going into recession. We haven't been in recession, and we're going to pull out of it. It's very hard to find any economic statistics that are at recessionary levels. We've been in a mere slowdown, a shallow one, and we're coming out of it.
Employment, definitely, right?
Employment's not recessionary levels. Not even close.
No. Wait a second.
In fact, Jared, I want to go on record as saying, you're talking about nominal wages and salaries.
No, I'm talking about...
And then when Jerry changed the field to talking about disposable personal income, all of a sudden you switched to real.
No.
You're very good at cherry picking the negative numbers. Nominal personal disposable income was up at a 1.8% annual rate in the month of April on a per capita basis, and a 2.7% overall.
Any knowledge of what payrolls have done over the past 4 months, Don? Let me hear it. Yes or no? What have payrolls done over the past 4 months?
Payrolls have fallen by 80,000, 80,000, 80,000, and 20,000.
Let me ask you this, Don.
You ask me a question, I'm going to answer it. You're just going to have to hold your tongue for a second. Now, typically, when you're 4 or 5 months into a recession, you're losing 250, 300,000 payrolls every month. This ain't a recession, baby, and it doesn't matter what the union bosses on your board of directors that pay your salary say. We are not in a recession.
Jared, can I ask you a question?
We have never had 4 months of payrolls declining and not been in a recession.
Jared, can I ask you a question? I've been wanting to ask you this question for a long time. Because whenever we talk about this, you trash the household survey and you always focus on payrolls. But right now, what you're doing as a contributor to this show, is this W-2 income to you, or is this 1099 income?
What are you talking about?
Does the payroll survey count what you're doing right now as a CNBC contributor?
The payroll survey? The payroll survey?
Does it count it?
Well, no, that would be self-employment. No, I agree with your point. No,
exactly. So the point is that what you're doing right now, trashing the household survey, it doesn't even count the economic service you're producing right now.
That's completely misleading.
No, it isn't.
I totally am with you in terms of what the household survey is picking up the payroll. I'm making a simple point. The data show, going back to 1950, that every time the payroll survey has shed jobs for 4 months in a row, we've been in a recession. Now, we may not be in a recession.
I got to get Pinto in here. I got to get Pinto because another big story this week, a huge story. Long-term Treasury yields went through the 4% level. Now, I regard this very positively. We have a chart that shows this move up in Treasury rates. And we also, if the chart shows up again, will show that it's a real interest rate move. It's not an inflation move. 95, 99, there you go. 10-year yields. Check this out. Basically, they've gone from about 330 to 405, 410. Okay, that's a big move. Now, notice the blue line is the real interest rate. That's from the Treasury tips market. You know it well. Everybody knows it well. They are moving in tandem. When real interest rates go up, Michael Pinto, that's a sign of better growth and better capital returns, and it is also defending the U.S. dollar and crunching down inflationary gold and oil.
Well,
so that's
Larry.
the bull case,
Every
Pinto.
time the dollar
What's your take on the bull case?
Every time the dollar has an uptick, you get excited.
I do.
I don't know why you get
excited.
so.
It warms my heart. I love hard money.
All the major averages are down for the year. Would you agree with that?
Yes.
And on an inflation-adjusted basis, they're
like
profoundly negative, okay? And Jared, let me ride to your rescue. If you inflation-adjust nominal GDP to anything that resembles real-world inflation, which is running around 7%, we are in a recession, gentlemen. Let's just accept it. The 38% is the average commodity rise so far this year. 38%. How could you sit there and claim that inflation is running at 3%?
Because we buy things other than commodities.
You don't even believe that.
Because we buy things other than commodities. That's not the only thing we buy. We actually turn those commodities into automobiles and flat-screen TVs. And those aren't up 7% over the past year.
And the dollar's down profoundly for the year.
Let's go. I've got another.
Which is forward-looking.
I've got another. Yeah, it is. And by the way, real interest rates are forward-looking. That's the beauty of getting through 4%.
And I want to say one thing
People
about
have shifted away from their panic, as Don Luskin described earlier. They are now moving out of risk-free treasuries. They are stopping their funding of the U.S. government,
but real rates
which
are
is
still
good.
profoundly negative.
They're not profoundly negative. They're rising. They're rising beautifully.
They are rising, but rates never rise because of growth. They rise because of inflation.
You'll like this chart, actually. It's a hard money chart. The federal funds rate is now expected to be raised by Bernanke and Company in October. Let's put the futures market up for the Fed funds rate. There's about a 50 or 55% chance that we're going to see we don't have it. So I'll just take my word for it.
I do.
It's
about 55% chance that the Fed is going to tighten up. The Fed is getting concerned about the dollar. That's good. They are concerned about commodities. That's good. They are concerned about inflation. That's good. So, Don Luskin, what does this mean? The rise in Treasury rates and the potential rise of the Fed funds rate, is that bullish or bearish for stocks? That's where I really want to go here.
I think the idea here is that the thing that is going to make the Fed raise rates is that the economy is recovering, and that's good for stocks. So when the Fed raises rates, the fact that they raised rates won't be bad for stocks because they wouldn't have raised them in the first place if it weren't for something else, the recovering economy, that was good for stocks.
Don, can I ask you?
Can I ask you a follow-up? Hold on a second. Don, look at these numbers this week. This is so important. The NASDAQ was the really big winner. It was up